ready money now.
Hi everyone, I'm Amaka. This time around, we're going to talk about the best strategies for investing that you should consider. So let's get to them. Number one, define your financial goals and risk tolerance. What do you want out of your investment? Do you want to simply ensure that down the line you guarantee the lap of luxury in eventual retirement? Or are you trying to make as much money as you can, retire early before your peers can get to mid management? Before even considering specific investments, it is very important to define your financial goals and risk tolerance. This will determine how your investment strategy will be built. Your financial goals are the specific objectives you hope to achieve through investing. These goals could be anything from funding your retirement to purchasing a home, paying for your children's education, or like I said earlier, a bit of jaye jaye. Each goal has a different time horizon and a different level of financial commitment required, which will significantly influence your investment choices. For instance, consider the hypothetical case of Sarah, a 25-year-old software engineer. Sarah's primary financial goal is to retire comfortably at age 60. This long term goal allows her to take on more risk in her investment portfolio as she has a significant time frame to ride out market fluctuations. She might therefore allocate a larger portion of her investments to growth oriented assets like stocks. In contrast, John, a 58-year-old accountant, is approaching retirement. His primary goal is to preserve the money he already has and generate income to support his living expenses. John has a shorter time, and so his risk tolerance is lower. He would likely go for more conservative investments such as bonds and dividend paying stocks to minimize potential losses. We've been talking about risk tolerance, but what exactly is it? Risk tolerance refers to your ability and willingness to withstand fluctuations in the value of your investment. It is usually tied to factors like your age, income, financial stability, and psychological comfort level with uncertainty. A young investor with a stable income and a long time horizon might be comfortable with a high risk tolerance, understanding that they have time to recover from potential market downturns. Defining your financial goals and risk tolerance is not a one time activity. It is an ongoing process that requires periodic review and adjustment as your circumstances and priorities change. For example, a job loss or stagnating business would mean a reevaluation of your risk tolerance and adjusting your investment portfolio accordingly. By carefully defining your financial goals and understanding your risk tolerance, you or your financial advisor can create a personalized investment roadmap that aligns with your individual needs and circumstance. Two, allow your investments mature. Even when your intention is short term profits, unless you're a day trader, and we know how that often goes for the inexperienced, the best position is to always buy and hold. It might seem like a meme, but it is sound economic advice worth paying attention. The graph below shows how popular indexes, when compounded year over year, have grown. And the same applies to these stocks here. Where many people fail with their investments are when they go for meme stocks or shady investment vehicles that promise chicken and the money doubler level of profit within a very short time frame. Three, simplify your investments. Start with low cost index funds. For novice investors, the vast array of investment options can be overwhelming. Individual stocks, bonds, options, and other complex instruments can be difficult to understand and require significant time and expertise to manage effectively. This is where low cost diversified funds, such as exchange traded funds, ETFs, and mutual funds, come in. These funds offer a simple and efficient way to gain broad market exposure, reduce risk, and minimize investment costs. Diversification is a cornerstone of sound investing. It involves spreading your investments across a variety of asset classes, sectors, and geographic regions to reduce the impact of any single investment's performance on your overall portfolio. Low cost diversified funds achieve this diversification automatically. Consider an ETF that tracks the S&P 500 index. It's called Standards& and Poor's, by the way. The single fund invests in the 500 largest companies in the United States, providing instant exposure to a wide range of industries from technology and healthcare to finance and energy. If one or two companies in the index perform poorly, the impact on the overall fund is limited because the gains from other companies can help to offset the losses. Mutual funds offer similar diversification benefits. For example, A total bond market mutual fund invests in a wide variety of bonds with different maturities and credit quality, reducing the risk associated with investing in individual bonds. Let's go back to our hypothetical investor again. Sarah, a young professional who started her investment journey by investing in a diversified portfolio of low cost ETFs. She allocated a portion of her portfolio to a US stock market ETF, an international stock market ETF, and a bond market ETF. This diversified approach allowed her to participate in the growth of the global economy while minimizing her risk. She didn't have to worry about researching individual stocks or bonds. The funds took care of the diversification for her. Low-cost funds are essential for maximizing your investment returns. Expense ratios, which represent the annual fees charged to manage a fund, can eat into your profits over time. Even a seemingly small difference in expense ratios can have a significant impact on your long-term returns. Index funds are a type of mutual fund or ETF that tracks a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. These funds are known for their low expense ratios and broad market exposure, making them an excellent choice for beginner investors. Starting with low-cost diversified funds is an efficient way to build a solid investment portfolio, especially for beginners. These funds offer instant diversification, reduce risk, and minimize investment costs, allowing you to focus on your long-term financial goals without getting bogged down in the complexities of individual investments. 4. Use dollar cost averaging to grow your investment portfolio. A good strategy is to contribute to your investment accounts regardless of market conditions in a regular, consistent manner. This can significantly enhance your long-term returns. If you are forgetful, you could automate this process as well by having a standing order to have a specific amount moved from your salary account to your investment account. This is what dollar cost averaging is. An advantage of dollar cost averaging is that since you're investing a fixed amount at regular intervals when prices are low, you buy more shares. When prices are high, you buy fewer shares. This ensures an average purchase price over time, preventing you from buying at peak prices or missing the dip as well. Dollar cost averaging is a simple way to take the emotion and speculation out of investing that can lead to bad outcomes and also help build investment discipline via consistency. 5. Prioritize financial education. So, we've learned that investing can be daunting, but there are ways to simplify the process and allow you dip your toe in it without getting swept away. Well, that's called financial education. You're welcome. But it doesn't end with this video. As time goes on, you should want to deepen your knowledge even more so you can make informed decisions about your investments, understand the different type of assets, the risks and rewards associated with each, and the importance of diversification and asset allocation. Financial education also helps you avoid common investment scams and pitfalls. A well-informed investor is less likely to fall prey to fraudulent schemes or make impulsive decisions based on hype or fear. At the end of the day, the point is that building a successful investment portfolio is a journey that requires careful planning, discipline, and a commitment to continuous learning. By defining your financial goals and risk tolerance, adjusting those goals as circumstances change, maintaining discipline and prioritizing financial education, you can lay a solid foundation for long-term financial growth and achieve your financial aspirations, whatever they may be. I'm Amaka, and that's all for this edition of Money Made Simple. Like, subscribe, and tell us in the comments what else you'd like to see us talk about. Cheers.